Most people hear the phrase fractional reserve banking and assume it is either too technical to matter or something slightly suspicious. It is neither. It is simply the structural design of modern banking. And once you understand it properly, you stop seeing your bank account as a vault and start seeing it as part of a system. Let us begin with something simple. If every depositor at your bank withdrew their money at the same time, would the bank have all of it available in cash? No. Not because the money disappeared, but because the system was never designed to function that way. Fractional reserve banking means banks keep a fraction of deposits in liquid reserve and lend the rest into the economy. If you deposit £50,000, the bank does not store £50,000 untouched. A portion is held as reserves to meet regulatory and liquidity requirements. The rest may be lent to a family buying a home, or a business expanding operations. It could go to a developer financing property, and it could lend to a consumer using credit. As a result, that lending generates interest income to the bank. That interest income sustains the bank's profitability. Now here is a critical clarification. Reserves are not the same as capital. This is where many misunderstand the system. Reserves refer to liquid funds held to meet withdrawals and regulatory liquidity rules. Capital refers to the bank's own equity buffer, the cushion that absorbs losses. After the 2008 financial crisis, capital requirements under Basel III became significantly stricter. Banks today must hold much higher quality capital relative to their risk-weighted assets. This is important, because when people say banks only hold a fraction, they are usually referring to liquidity reserves, not capital strength. Modern banking is far more regulated than pre-2008 structures. Now, a brief historical context helps. Early banking evolved from goldsmiths who realized not everyone redeemed gold at once. They began issuing more receipts than physical gold held, based on predictable withdrawal behavior. Over time, central banks were established to stabilize this system and act as lenders of last resort. Today, central banks manage liquidity, interest rates, and systemic stability. Fractional reserve banking is not an accident. It is a growth mechanism. When banks lend, credit expands. When credit expands, investment increases. When investment increases, productivity can rise. However, expansion also amplifies cycles. This is where it becomes relevant to you, because this system influences asset prices, interest rates, liquidity conditions, economic cycles. Let us look at real stress events calmly. In 2008, banks faced solvency issues due to excessive risk-taking and poor asset quality. In 2023, several regional banks experienced liquidity stress because rapid interest rate increases reduced the value of long-duration assets on their balance sheets, while depositors withdrew funds quickly. These were not examples of money disappearing. They were examples of liquidity and duration mismatches under stress. The structure was strained. When you understand this, panic decreases. You see stress as structural, not mysterious. Now let us bring this back to your personal position. Your bank account feels like static cash. In reality, it is a liability on a bank's balance sheet. You are an unsecured creditor of that institution, protected up to certain limits by deposit insurance. In the UK, the Financial Services Compensation Scheme covers up to £85,000 per institution. In the US, FDIC insurance covers up to $250,000 per depositor per bank. Above those thresholds, your exposure changes. Most households never consider this. Institutions always do. That does not mean you must spread money across 10 banks. It means awareness matters. Now let us discuss opportunity cost. Banks may lend at 6 to 8% while paying depositors 1 to 3%. The spread funds operations and profit. If you hold £100,000 earning 1% while short-term government bills yield 4%, that 3% differential is £3,000 annually. Over 10 years, assuming reinvestment, the difference compounds meaningfully. Again, this is not about yield chasing. It is about intentional positioning. Now let us create a simple household treasury framework. First, define essential liquidity. For example, if your baseline monthly cost is £3,000 and you want 6 months of stability, that is £18,000. That capital's job is protection, not performance. Second, define strategic liquidity. Perhaps an additional buffer for upcoming expenses or flexibility. Third, define surplus capital. That is the portion that can be allocated to short-term government instruments, investment assets. Debt reduction, business capital. Fourth, monitor deposit insurance limits relative to your exposure. Fifth, understand that cash sitting indefinitely in low-yield accounts is a decision, not a default. Fractional reserve banking is not a flaw in the system. It is the reason credit exists. Credit drives growth. Growth drives asset appreciation. But understanding the system prevents you from being passive inside it. Once you understand how money flows through banks, you start thinking in terms of allocation rather than storage. And that shift from storage to allocation is where structural intelligence begins. After all, there's no reason why you can't profit from this, just like institutions do. In the next episode, we will examine money creation in more detail and connect it directly to why asset prices often rise before wages. Because once you understand the flow of credit, you understand momentum. And momentum is rarely random.